Good morning. This is John Strohmeyer from Strohmeyer Law. We are waking up to the New York Times revelations about Trump's tax returns. They released on Sunday a big long report about everything that Trump has been doing with his taxes. Obviously, he's been trying to hold those back and not release them for years, but they have gotten this out. So I'm going to walk through just the 18 Revelations article just to tell you what I, as a tax attorney, think about these. So this is not meant to score political points. It's just here, when I read through this, what do I see? What do I think about this? To give away some of the end game, there are a few things that I saw in the Times reporting that I think intentionally shade the truth against Trump. That may not be a surprise, but here we go. So, again, New York Times obtained tax return data for President Trump and his company for the last 2 decades. That initially makes me say, well, did they get just the data? Because it's possible to go to the IRS and get a list of all just the numbers on the return and not get, did they get all the schedules? Did they get all the supporting documentation? There are photos out there of him signing, 3-foot high returns. What did they get? I'm, just going to skip over that for now, or skip past that for now. Here are the key findings. What we'll get to are the actual 18 bullet points that the IRS, or that the New York Times listed as their revelations. But, reduced his tax bill with questionable measures, paid no income tax for the years examined. This, I think, is going to be a bit misleading because they say that he paid no tax, but it doesn't mean he owed no tax. So we'll get into this more, but the short version is I think they're kind of shading it against him in a way that obviously people have picked up and run with, he only paid $750 when later on we'll get to a line that says that he averaged about 1.4 million per year. So again, President's tax avoidance point number 1, paid no federal income taxes for much of the past 2 decades. So he owns a lot of real estate. And what that means is when you own real estate, you're generating depreciation every year on the dirt, or on the building, but not on the dirt. So the Internal Revenue Code, or the IRC, allows business owners to depreciate buildings so that each year they get to take a tax deduction for part of the value of that building. There's a lot more to that. I'm not going to really get into what and how depreciation works, but just know it's one of the benefits of owning real estate. Now, you're generating this depreciation every year. Well, what happens when you sell the building? What you're doing is you're reducing the basis of the building. So if you bought the building for 100, you pay, and the land underneath it for 100, so you're paying a total of 200. Well, you're going to take a portion of that 100 you paid for the building as a deduction every year. So essentially, the cost of that building, it's going to be subject to wear and tear, things like that. Every year, you get to write off some of that, essentially as you're taking a loss early. There's more to it. Yes, I know I'm not going into all the details, nooks and crannies. Folks watching, yes, I know. But the idea is when you go and sell it, you're not going to be able to take that amount that you paid in to offset your later gains. So if you buy for 100 for the building and 100 for the land, 200 total, and you sell for 250, well, normally you'd have $50 worth of gain. But if over the years you had taken $50 of depreciation on the building, you'd actually have 100 in gain. So start off at 200, 100 for the building, 100 for the land, $50 of depreciation. So you're at 150 of basis. When you go and sell it at 250, you're taking the difference between the selling price and the basis. So 250 over 150, and you're paying tax on that $100 difference. Now, depending on buildings, the building may go down in value, but it might be the value of the dirt that has gone up. You can't depreciate the dirt. That's just something you can't do, but the building is subject to wear and tear. So it's, all of this is to say, when they're saying he's paid no taxes, first we talked about, well, paid no taxes. That strikes me as, just because he didn't have a payment due and owing doesn't mean he didn't owe taxes. Also, because he owns a lot of real estate, those deductions, the depreciation deductions, end up providing a lot of deductions for business owners. It comes back at the end when you sell the property. Well, you're going to have to pay the gain then. So let's see. Item 2, tax avoidance sets him apart from most other affluent Americans. That's right. Look, people pay taxes. If he was, he was paying, I mean, we'll get to it, but the average was 1.4 million per year, but taxes on the wealthy declined. That's true. Used loopholes. Loopholes are always a buzzword. It's a loophole if you don't like it. It's a tax advantage if you do like it. It's an opportunity. The fact is, nobody pays at statutory rates, and this is just trying to incite things with people. I think this is not fair. I mean, what we have in the U.S. is a statutory ladder system, and let me see if I can't bring this up. The tax rates. What happens is, if you get taxed on income, actually, here, let's just IRS 2020 tax brackets. So doesn't really matter where we're going to. We're just going to take a look at this. The tax rates, and this is true for any year, the tax rate, when you get up to the highest rate, the 37%, you're not paying 37% on all of it all the way down. This is true for every rate. 10% rate, once you get if you're single, up to that first $9,700 in taxable income, you're paying 10% on that. Once you get to 9,701, you're paying 12% on that first dollar after 9,700. It's not as though you hit 9,701 and then you're hit at 12% all the way back. It's $970 of tax on this first, just for income tax purposes. Then for the next $100, so 9,701 to 9,800, you're paying $12 of tax on that instead of 10. Then you're paying 22% on the next bracket up, 24%. So things go up. So you're never paying, unless you're in the 10% bracket, you're never paying this full tax rate. And that's true for all of us. So don't think, paying less than the statutory rate, that strikes me as words meant to, it's just not fair because it doesn't reflect accurately what's going on. This next line, sure, lots of people pay lots of federal income tax. Again, we're going to differentiate that between the excise taxes we owe on Social Security payments, the 6.2% and the 1.45% for Medicare. Those are separate taxes. They're imposed on wages. Different thing. We're going to get to that later. Here is kind of the thing. Well, look, average federal income tax rate for the highest earning, blah, 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 was 24%, according to the IRS. So that's, basically, again, we're seeing what we saw before. Like, even though you're at 37%, it doesn't mean you're paying that rate. And so this is probably true. There's a lot going on, and kind of thinking down the line, if he ended up owing an average of 1.4 million per year, he's probably still way below. Like, it's not to take away from it, but it's hard with these top line numbers to see what's really going on. Tax avoidance sets him apart from past presidents. Sure. That's why people are rushing to cover this. There's not much else to do that. That's kind of history speaking for itself. The large refund. So this is where I think people are getting confused. We've seen the $750 payment. When I hear that, what I hear is he only had to pay in, like the check he wrote was $750. It doesn't mean that he owed $750 total. Why? Well, the refund reduced his total tax bill between 2027 to an average annual of $1.4 million. Again, this is way more than $750. That alone doesn't jive with 750 being the only thing he paid. If New York Times, like, I feel like they're just kind of shading the truth, and it's not really, it's not being fair to him. And this is not to get political about it. It's just like, look, if he owed $1.4 million for 17 years, that is a big pile of tax. So let's keep that in mind with the 750. So he had large tax bills, and then he had this, he initially paid $95 million over those 18 years. That is a big payment. That's not paying nothing. 95 million over 100 years is still a lot of tax, and keep that in mind. So he then had this $72 million refund. What I imagine has happened is he claimed the refund and has been using that refund to offset what he thinks, or what he's reporting as being owed. So if he owed, in pick a year, he owed $3 million. Well, I've got this $72 million tax refund. Well, look, he paid 95, thinks he's owed a refund of this. Well, then here, I'm going to open up the calculator. 95 million minus 72, let's just call it 73 million, is 22 million divided by 17 years. That's $1.3 million approximately per year that he'd have as an offset. So what he was probably doing is calculating his tax and then saying, look, I paid 95. I'm claiming a 72.9 million refund. I don't know what that's for. He seems to think he's open to that. Look, that he's been fighting an audit. That doesn't seem to be in dispute at all. That's the next line is, there's a long running battle with the IRS over that refund. Well, he's just taking that and saying, look, this is ongoing. I'm going to apply what the difference is, what I think I still have left. I think he's that may be how it's working. It's hard to tell without looking at the returns. But again, this refund, he's probably been using it to offset what he owes. And so there's a difference on those returns between what he paid and what he owed. If he owed $1 million and had previously paid $9,999,000, figure all the rest of that out. If he only paid the difference, it doesn't mean he didn't owe the full amount. It's what did he, New York Times is saying he paid $750 in 2016, 2017. Is that what he owed? That's where the difference is in these two things, and that's what I think we should be looking at. So next point, 72 million refund has been a long-standing battle with the IRS. This is what we know. It's why he's claimed he can't return things. That's a story for a different day. That's a political fight, and I don't really care to get into that. When applying for the refund, he signed a giant financial loss that must be related to, okay, sure, there we go. Publicly claimed he had fully surrendered his stake. So basically, to take full loss, you've got to give up everything. As it says, you have to give it all up and take nothing back. Well, if you take that 5% back, you really haven't given it all up. So that's probably what they're fighting over. Business expenses. Next point, classifies much of his spending on personal lifestyle as the cost of business. This is true. You can't take personal deductions for your taxes. It's why we can't deduct haircuts or cars that we use just for personal things. But the difference is, once you are in a business, you can start taking deductions for things like that. So when he was on The Apprentice, on any other TV show, getting prepared for the show involves being prepared, looking good. And so having somebody style his hair during The Apprentice, while it's odd to most of us, The Apprentice was a business. It was essentially, unless you think we can get into whether it's advertising or marketing. That's not really the point. But if it's a business and they're trying to produce a profit, the costs incurred in attempting to present that product, it's no different than buying a car for a business, spending money on paper for printers for a business, paying employee wages in a very broad style of it's a cost associated with that business. If you're producing that business, then the costs associated can be used to offset the income from it. So it works in the context of a business. This, you know, just because it's odd, it's normal in the context of a business. You're probably going to see, I mean, the wages that NBC, CBS, Fox, ABC, Comedy Central, everybody spends on their staff who are makeup artists and hairstylists to put their TV personalities on the air, that would be deductible for them as well. So it really is, it looks pretty much the same. That it's odd, but it's not like a, ooh, we gotcha. Seven Springs is typifies his aggressive definition of business expenses. All right, well, you know, aggressive, this is where there's a line to be drawn. You know, you're not supposed to be doing, you're not supposed to be using business things for personal, looks like they were taking vacations there. So investment property, you know, you can write off some of the property taxes. There are lots of rules about rental real estate where if it's vacation home, you can use it for a certain number of days per year. There may be something here, but this might just be, if you don't see it and you haven't seen it before, of course it looks odd. Consulting fees. Across nearly all of his projects, he has set aside 20% of income for consulting fees. So again, like you pay an employee when you're paying outside contractors, that's cost of doing business, you're going to be able to take a deduction for that. So that's right. The flip side is, well, you're taking taxable income from the business and making it taxable income for the person receiving it. So if he received $100 of income and then paid a consultant $90, he nets out to $10. The consultant, but while he's only picking up $10, the consultant's picking up that other $90. The tax system doesn't miss it. You know, it's still like we've pushed it from one person to another, but ultimately we're only paying tax on that income once. So there are rules that get into this. And the next point here, you know, his daughter appears to receive some of these consulting. I don't know a whole lot about this, but when you start getting people involved who work for you, I know there are rules about this. You know, the paid her $747,000 for consulting projects. That's quite a lot of money. So, you know, there's probably more there. Money losing businesses. So I like to tell clients, if you're paying tax, that's a good sign. That's a sign of a healthy business. So losing money, this is where I'm not sure if the depreciation is coming into it or if he's actually losing money. What little I know, you know, he's just licensing his name. He doesn't necessarily own the business or the underlying assets. That's a lot of money. And there, you know, this may be less of a gotcha than a embarrassing, you know, if he's losing actual money because these things aren't putting out revenues as he imagined, that's more embarrassing. It's hard to tell without knowing, you know, seeing more. So again, here's earning profits every year on Trump Tower. So then next one, most successful part of the business is personal brand. You know, between 2014 or 2004 and 2018 made 424 million, just quick numbers, 427 divided by, call it about $30 million a year. Well, $30 million a year and a 1.4 million average tax bill. Obviously that's not a great tax rate. So just 1.4 divided by 30 million, that's about a 4%, 4.5% effective tax rate. Obviously very low. But the marketing, so, well, and then we get to the next point. In unprofitable business still served financial purpose. He's reducing his tax bill. So again, if he had 30 million average per year in gains, but he had 29 million in losses, Well, you don't pay tax on everything and don't get the benefit of those losses. Somehow you're taking a loss that's available to you under the tax code. So if he's only paying tax on that 1 million, I mean, it's still tax there. You know, he's got a 1.4 million tax bill. Ew, let's just say, oh, where did I put the calculator? I mean, if he paid 1.4 and if he paid 1.4 and he was actually, his effective tax rate was 24%, like the other wealthy people, like we'd mentioned earlier, that's about a $5 million, $5 million to $6 million in income, more or less. So maybe it means he was making 30 million on his businesses or on branding, then losing, whether it's through actual loss where he's paying out more than's coming in, or it's depreciation. He nets him down to about 6 million a year. He's paying 24%. That gets him to an average of 1.4. He's then got that refund he's claiming to offset. That may be how he's getting there. It's confusing and not obvious, but it's something to think about. Let's see. Large tax bills looming. Next thing. So with cash from The Apprentice, so he made a bunch of money, that $95 million payment, went on his biggest buying spree since the 1980s. So again, he's buying real estate that generates depreciation deductions. So he's buying 10 golf courses and multiple other properties. So losses reduced at those properties reduced his tax bill. Like there's nothing magical about that. If you've got losses, whether they're, a depreciation is essentially treated like a loss in that it's going to offset your income. If he's actually paying out more, like it's not generating enough income, that would generate a different type of loss. So what we see, Apprentice started to decline by 2015. Financial condition was worsening. So this, I'm not sure, this may be a conclusion from the returns. I doubt they said it anywhere on those tax returns. And so financial records, again, they're saying financial records, and maybe I just missed the line, but they may have gotten line item data from his returns and not the full returns. Announced a that's interesting. Maybe it was all a marketing stunt. Another one, the presidency has helped his business. It seems like, here, large bills looming. This is getting out of, me as a tax attorney, so we may be close to the end here. Presidency has helped his business. Surge of new members gave him an additional 5 million a year since 2015. All right, well, yeah. So there's value to having Mar-a-Lago as a club where people can get in to have closer access to you. The propriety of that is, again, beyond this little talk. So surge of new members. I think I read somewhere that he's since raised prices. Maybe the presidency as a result. Many of his businesses continue to lose money. Yep, that's not a good thing. You would rather make money than lose it. So in 2012, took out a $100 million mortgage on the commercial space in Trump Tower. One of the things that I see people get confused on a lot is loans are not income. Why? You're bringing the money in, but you also have an obligation to repay it. So if you borrow $100 million, yeah, go buy all the Fabergé eggs and Maseratis you want. What you're not going to get is, a tax write-off, or you don't write that down on your 1040 as part of gross income, because you're going to have to pay that money back. So if you borrow $100 million, turn around the next day and send it right back, nothing really ends up on your tax return, or there's no net change to the tax return, because there were strings attached to that $100 million. So then he also sold hundreds of millions worth of stocks and bonds. That's interesting that 2012, they don't, maybe that was in 2012. I can't really tell. Financial records, again, it's hard to tell. You wouldn't necessarily list all your assets on a 1040, so I'm not sure what other records that's coming from. Soon face several major bills that he's going to have. So paid off none of the principal on the mortgage. So, if you're familiar with 7-year ARM and other types of mortgages, you may only be paying interest for the first few years. If you took out, 10 years interest only payments, not uncommon, or not unheard of. There you go. You just kind of go back, reborrow it, and keep paying interest. Brings to mind the saying of, if I borrow $100 and can't pay, if I borrow, if I borrow $100 from you and can't pay, I have a problem. If I borrow $100 million from you and can't pay, you have a problem. Then if he loses his dispute, so somehow the businesses will have to come up with 100 million, because that mortgage, maybe I missed it earlier, but that's probably through some entity. Bankruptcy could discharge that, in which case, the loan on that wouldn't have been free. It would have been what we call a secured note. So whoever the bank was that loaned it would have said, look, we're taking a security interest in Trump Tower. So if you don't pay us, we get to take the building. They may, whether or not they do that and foreclose, it's no different than when you take out a mortgage on your house or refinance your house. Can I talk this morning? I haven't had enough coffee, who knows? Or when you buy a car, yes, you're borrowing money and you drive away with a thing, but the bank or the lender still has an interest in what you own. And that's why you've got to carry you've got to carry insurance on that property. So if the house burns down, you total the car, or something happens to it, the lender isn't completely out. They can still get cash from that insurance policy. Oh, look at this. Personally on the hook for some of these bills. So nearly ruined himself by personally guaranteeing hundreds of millions in loans, since said he regretted doing so. And it looks like he's been doing that again. Responsible for loans for loans totaling 420 million. That is a lot of money. Most of which coming due in the next 421. Just mixing matching words here. So responsible for loans totaling $421 million, most of which come due within 4 years. That's a lot of money to be on the hook for. Again, you can always go back, borrow anew, kind of roll over the debt. He said he's done that before. There's nothing wrong with it. As I was saying a few minutes ago, when you borrow money and then, you don't have income. So if he comes back and just kind of rolls it over, there are ways to do it. There's a whole lot in it. So what we've got are a lot of, there is smoke here. There's stuff that's odd. There are things where I don't think the New York Times is being as charitable as they should be. I saw some other notes. They didn't get into this. The president paid, I think, to India like $145,000, and he paid the Philippines $156,000. That is a way that our U.S. tax system works. The U.S. tax system starts with, if you're a citizen or a resident alien, then what happens is you are responsible for paying and reporting worldwide, or tax on your worldwide assets, income, deductions, credits, all of it. So even if you're living here in the US, but you make money in India or the Philippines, you have to report and pay tax on that income to the United States. Well, the thing that we have to resolve is that India is there first, for example. So India gets to take a bite out of that income first. Why? It was generated within their borders. They're going to tax that income, so you have to pay them first. The U.S. has two options. You can get only one that really applies here. The foreign tax credit means that you get a credit against your U.S. income taxes for income taxes you pay to another country. So when you are, if you have $100 of income in India, India charges you income tax. Well, you're going to pay tax there first, and then whatever's left, you pay here. So kind of three assumptions. Easy numbers, 40% tax here in the US. If India charges 20% tax, you'll pay $20 in tax on that $100 of income in India. There's a $20 delta, so 40% minus that 20%. You'll still pay 40% that you'd pay here in the US, 20 to India, 20 to the US. If India taxes it right at 40%, right equal with the US. You pay 40 to India and nothing, it nets out to the US as zero. Now, what if India taxes it more? What if they tax it at 50%? Well, $100 of income taxed at 50%, $50 goes to India. There's nothing left. You don't get a deduction against your US income tax here. So he doesn't get a bonus $10 of deductions he can claim here. So that doesn't really bother me when I see that he's paid taxes elsewhere. It just means they took the taxes out from there. Again, the other one, he only paid $750 in taxes for a few years. That means that the check he wrote was probably only $750. It doesn't mean he only owed $750. I'm sure there's more coming out. The New York Times has said there's more going to be coming out. When we know more, I will come back and talk about it. So if you've got questions about this, drop a question or comment in the comments below. Let us know if you've got questions. What don't you understand? What do you think is going to happen? There's a lot to digest here. We're only just getting started. So thanks for watching. We'll be back soon.